Hello, my name is Andrew Thake and I'm from Minds and Money. I'd like to welcome you to our keynote panel, which is from exploration to production, financing trends and options in a post-pandemic world. We're joined by four esteemed panelists: Warren Gilman, Chairman and Chief Executive Officer of Queen's Road Capital; Bert, Managing Director and Partner of Denham Mining Fund; James Morrison, Managing Director of the Resources Royalty Fund at Gresham; and George Pyper, Managing Director Advisory of Endeavour Financial. Thank you very much to you all. I'd probably like to kind of kick off with a question to George. So what financing trends have changed over the last year?
Thanks, Andrew. Thanks very much for having me on this panel, and good morning, good afternoon to everyone listening in. It's a good question. It's been a funny year, really. I think probably it's quite hard to look at anything other than thinking about the impact of COVID and the pandemic and how that's affected our industry and getting financings completed. I think that generally the market is very positive, though. I think there's quite a lot of views about commodity super cycle, and there certainly seems to be plenty of capital from where we sit in terms of having appetite to put funds to work in the sector, both from the equity side and the debt side, and all sorts of exciting financing instruments in between, some of which the gentlemen on the panel are obviously keenly aware of. So I think my short answer would be a generally improving trend, certainly compared to 12 to 18 months ago. But COVID has had an impact in terms of speed of getting deals done and ability to get people to sites, do due diligence. That certainly has an impact. That would be my short answer.
Sure. Bringing in Warren, under lockdown, of course, you're obviously based in Hong Kong. How has the industry managed to do business over the last 18 months?
Well, we've certainly managed to do business incredibly well. We've seen the boom in several sectors within the industry. So it certainly hasn't impeded companies from discovering new ore bodies, from financing that activity, from M&A, which has reasonably been active as well. So it hasn't slowed anyone down one little bit. Your question, though, was how? And that's an interesting question, because obviously with some difficulty, but what people have been able to achieve over the course of the last 18 months, given the circumstances, is quite impressive, quite astounding. And maybe that's reflected in the move in the markets that we've seen over the course of the last 18 months, because I think the markets have seen this level of activity, and it's been sort of a virtuous circle in terms of reinforcing itself. People are getting on with life and doing business. Again, under the theme of how, I think it has been partially at the because of the adoption of greater risk. I say that for our own example, using Queen's Road as an example. I mean, clearly the amount and degree of due diligence that one would like to do before one makes an investment has been impacted. I used to have a philosophy and a belief that I would never make an investment unless I personally put boots on the ground. And I've always run the business that way, but I haven't been able to run the business that way for the last 18 months. I've been here in Hong Kong for the last 12 months. I have not traveled anywhere. And yet we've managed to source and close probably 4 or 5 successful investments since I've been here. Obviously, I haven't put my personal boots on the ground, and from my perspective, that is an added level of risk that I've had to adopt. Now, doesn't mean that we don't put boots on the ground. I have colleagues who aren't based in Hong Kong who can travel a little bit more freely than I can. And there are always resources that one can access within the country that you are making the investment in. But clearly that's not the same as you yourself laying eyes, putting hands on, and putting boots on the property or the main asset that you're going to invest in. So we've had to adapt. I think the world has obviously had to adapt. What is perhaps surprising through this whole period is the willingness of people and the willingness of the world to adapt. But it's become the norm. Everyone has moved on, and that's the world that we currently live in. And hopefully it won't last forever, but it does seem to be functioning reasonably well.
Bringing in Bert, Koth. If mine financiers and investors are adopting a greater risk profile because they are unable to travel directly to the mines in order to do their traditional due diligence, how do you as a private equity fund go and mitigate that risk?
Well, first of all, I don't think that private equity firms are willing to, in general, adopt a much higher risk. I think the way, I would characterize what's happened as follows over the last 12 months, and I think this is going to go on for another 6 to 12 months still. First of all, deals in certain jurisdictions where it's really difficult to travel in COVID times just don't happen, right? And we had a few of those ourselves in our portfolio, in our deal pipeline, where if people have to spend 6 weeks in due diligence in 6 weeks in quarantine in various jurisdictions, just for a 4-day site visit or so, you're not going to get the A team to travel and carry out that due diligence, right? So that's just one reality. That means in certain jurisdictions have become non-transactable over the last 12 months, temporarily so, right, as a result of COVID. So I think what I'm saying is that deal making has, for the time being, shifted to easier jurisdictions where there's less travel restrictions or where there's already a critical body of technical expertise on the ground that can be locally mobilized, right? So I think that was definitely one solution to the problem. And another trend that we have seen over the last 12 months was some shift towards more structured deals as opposed to ordinary equity deals in the private equity world. And that has 2 reasons. One is also because it kind of provides a little bit of better downside protection, right? But also kind of in order to bridge the gap between the returns that private equity investors need and the already very high valuation levels that you find on the public markets, because you'll find in many cases entry valuations where it does not make sense for kind of sector knowledgeable investors, frankly speaking, to invest anymore, right? What that also has meant in some cases as the steel making has shifted to metals and minerals that are a little bit, shall we use the word off-beast, so not totally mainstream. I mean, we, for example, just recently closed an industrial minerals deal in South America, right? So you're basically to some degree transacting commodities that are maybe a little bit less well understood by the public markets. And then lastly, of course, there's now more ESG pressure and the high ESG expectations on deal making as well. I would say these are kind of the main trends for the last 12 months. More selective in which geographies you seek to transact. B, somewhat a bit of more a shift towards structured finance. Thirdly, more ESG. And then also, let's not forget, it's a great exit environment right now. For the entry environment, it can be challenging, but the exit environment is really good.
Thank you very much for that. And we'll certainly be returning to some of those points you've raised, such as ESG, later on in the panel. Just bringing in James Morrison, you're obviously in the royalty and streaming business. What sort of trends have you been noticing? I think James is just unmuting himself.
Yeah, thank you. So I can probably start off by giving you a few deal stats from last year. So now I'm talking specifically about Australia, and I saw about 24 transactions done in Australia last year, totaling about 650 million US. The majority of which were financing transactions. The majority of the amount was in financing transactions. And when I looked at the numbers, Australia was about 20% of the total in royalty and streaming transactions last year. This year, I've seen a number of existing royalties trading in Australia and elsewhere. I probably haven't, and I've seen one or two larger financing transactions, but I would say that on the whole, there has been the equity markets have been very willing to provide funding. I think, as Bert was saying, I think very good valuations for those companies proposing projects. So there's probably been less opportunity in the royalty and streaming space most recently. Other trends I've noticed are that I've seen certain royalty companies focusing on different aspects of the market. So I've seen some who are looking to do multi-commodity strategies, others that are focusing purely on gold, and others who are focusing on projects which appear to be, I would call them early stage, exploration to perhaps pre-feas stage. And so they're acquiring royalties over those projects. And so there's been somewhat of a splitting in the themes between the different royalty companies. And of course, the other thing we've all noticed is there are a lot more royalty companies than there were 2 years ago.
And just kind of like on that, there's certainly something that I've noticed on this side of the world, in EMA in North America. What are the specific reasons for this? I know it seems around now 20, 30, 40% increase in royalty streaming companies. If you had to identify a couple of sort of drivers behind that, is it just a commodity super cycle?
Look, there's a couple of trends which are very evident. I think, yes, the very strong commodity price cycle has been very supportive of new strategies. Secondly, the dramatic success of the incumbents, of some of the most established players, I think that has encouraged a lot of a lot of people who'd like to copy those strategies. And I also think that there has been a number of companies selling off portfolios of royalties which were otherwise unseen and achieving very good valuations for their shareholders. And I think that's also prompted some of the less well-known companies to come forward in that sort of environment.
Okay. Well, a couple of questions sent in from the audience. I think one just to follow up to something that you raised earlier, George, at the start. You talked about the speed of deals getting done, sort of like taking longer. Can you just give us like an idea, I guess, from your experience at Endeavour Financial, both sort of pre-pandemic and the situation we are in 2021, how the sort of like length of deals getting done has changed?
Yeah, sure. Thanks, Andrew. So I think generally the market, particularly on the sort of project finance side. So just to take a step back from our business, we basically help mining companies get projects into production. So some of the financings that we do are from private equity groups, some are from streaming royalty groups. Sometimes it's what I would call sort of traditional senior debt in terms of banks and export credit agencies and development institutions, development banks like the IFC, part of the World Bank. And I think particularly, and reflecting actually back to what Warren was saying about boots on the ground, it is a bit of a golden rule that, you know, you've got to go see the asset yourself, you've got to meet the management, you've got to meet the local team, and you've got to get there. And I think at the beginning of the pandemic, basically, particularly on the bank side, there was a lot of processes of sort of internal portfolio assessment. You know, how are our existing clients going to deal with the current downturn? As people remember, commodity prices took a steep dive, and there was a lot of basically sort of navel gazing isn't the right expression, but internal assessment of how do we look, how is our book portfolio looking, and deal teams didn't really have the capacity. They couldn't get to the assets, but they also didn't really have the capacity or the appetite to put new deals through their credit committees. And so there was quite a long delay, really, for the first half, from our perspective, for our clients in the first half of 2020, where transactions simply weren't getting done. So a general rule of thumb for a project financing for us and our clients, we would say it's probably a 6 to 9 month process. And that was extended out, basically, where deals that we would have expected to close in say May or June 2020, we didn't close until the end of 2020. So there was a sort of 6 month hiatus at the sort of more conservative end of the space in terms of senior debt with commercial banks and development banks. That has definitely improved. So the sort of logjam, if you like, of banks dealing with their internal issues has definitely improved. It definitely abated, and so transactions are now getting done more rapidly, and I think we're in a better shape, and it's probably getting back close to that 6 to 9 month process, with the same change or evolution which Warren was talking about, which was that rather than, you know, getting to Brazil yourself or getting to Burkina Faso, you have to rely on consultants that are on the ground in those countries, and that means that if you haven't got a consultant that you know and trust in a particular country, it's going to be really, really hard for you to get that transaction done. Which was the point that Bert was making. So I think that the sort of the long end of the process is 6 to 9 months. Once companies are ready to get into production, things can get done a lot more quickly if they need earlier money, if it's an equity process, or if they're looking for capital to get them through pre-feasibility study or feasibility study. The other thing we're seeing is also that groups are able, not banks, but groups as alternatives to banks, are able to put funds in earlier, and they basically will do a sort of sequence of fund drawdowns and basically say, if you meet this objective, you get some more funding, and it's sort of a tranched approach, and that's become a lot more prevalent, I think, to reflect the fact that, you know, people need to see how the business develops, and it's harder to do that now, so they're putting a slightly more cautious approach in terms of how those drawdowns take place.
A question for Bert. So, and I realised I was just sort of saying in the sort of back sort of like green room before we started that the title of the panel is a bit of a misnomer. Saying we're in a post-pandemic world is, of course, not true. We're going to be in this sort of situation for the next couple of years. But looking sort of, I know, 2, 3, 5 years down the line, you know, 2025, will this has become the established way of doing mine financing, that we're going to be okay about doing financing without having to do site visits, which is usually sort of like the one thing that we kind of must do before doing financing, or will it kind of go back to normal?
Well, I can only speak for ourselves. We are not going to do a deal without a site visit and without proper technical due diligence, period. And so what that means is, as I said before, in countries where we can mobilize due diligence resources, or where we found a way to travel, right, we will transact and have transacted, right? And in situations where you really can't travel for whatever reason, because there's still COVID or there's excessive quarantine requirements or whatever, in such situations, we will not transact, right? So I do not think that, I mean, to be clear, every situation is different as well. I mean, as Warren says, I mean, he couldn't himself put the boots on the ground, but at least he could mobilize a critical mass of trusted consultants, right? And that gave him the comfort and the confidence to transact, right? Now, we've done deals now the last 18 months where I couldn't go personally, likewise, right? but where we could actually mobilize a critical mass of trusted consultants. And as you mentioned before the recording started, Andrew, we have a number of offices in a number of places, and we have a bunch of trusted management teams on the ground in several jurisdictions, right? And so by having that, we were able to kind of transact on a number of situations. If we didn't have that, I think we would have seen much less activity in our portfolio. So I do think the world, it's gradually going to return to normal, Andrew. It might take another year or another 2 years, right? But I don't think that in an industry that has the technical risk profile of metals and mining, I do not think that investment processes are going to change such that large checks are being written without real due diligence. I don't think that's going to happen. And it should not happen either, because that's going to damage capital in the long run.
Yeah. One thing we touched on earlier, I think Bert touched on in one of his earlier answers, talking about the impact of ESG. So let's delve into that a little bit deeper. Warren, ESG. How is ESG going to go and shape mine financing going forward?
I know there's been a lot of discussion about it. I think it's going to change financing quite a bit, given the demands of investors generally. For specialist investors like your guest today, myself and Bert and Endeavour, et cetera, and Gresham, frankly, I don't think it changes anything that we do or have done, because I think ESG, maybe it had a different name, but it was always, environment was always critically important for us. You know, social license was always critically important. Corporate governance, always critically important. So I don't see the activities of any of us on the panel today really changing significantly. It certainly seems to have come up on the radar screen of both retail and institutional investors much more highly than it has been. And they might place a lot more importance on it than they might have in the past. Certainly from an issuer perspective, they're going to have to do a lot more from a documentation perspective, from a disclosure perspective, from a monitoring perspective, to demonstrate to their broader shareholder base that they're doing the best possible job they can with respect to ESG. I think maybe those are issues that their broader shareholder base didn't look at in the past in as much detail as we as professional investors always have. So there will be a lot greater onus and responsibility, I think, on the issuers going forward. And that's a great thing. That's a really good thing. And I hope it's not just a knee-jerk reaction to the demands of the larger institutions. I hope it comes from a place of realizing and recognizing that for their broader shareholder base, they need to be demonstrating that they are doing this work.
Sure. Question for James, this is partly based on a question sent in from the audience. Is the cost to is the push to decarbonisation costly? And if so, how does it impact mine financing? Or would you actually say that actually the push to decarbonisation is not a costly endeavour? And if so, why?
That's a question directed to me.
Yeah.
All right. So I would say we're all noticing. I mean, these are very big themes and long-term trends. And so if you're talking about is it financing a trend towards decarbonisation and making that happen, I think there's probably unlimited capital for strategies which can be seen to be decarbonising the economy. I mean, there is more and more money available for those sorts of projects. There is no doubt about it. And so I think that though most managements are setting them, many of the larger companies are setting targets to become net zero, to trying to actively show how they're going to achieve certain ways to decarbonise their businesses. And I think that that's obviously receiving a lot of investor support. I even talked to a company the other day who has, let's call it, they're in the battery metals business, and they're seeing different lenders than they've seen previously emerging because of the commodity which they're going to be producing. I think it gets much more difficult when you start talking about the expansion of, let's call it, thermal coal mines, and because obviously they have to go into hands now where those concerns are less worrying for investors. I'm not sure if I'm answering that question correctly or appropriately, but I see the big trend. I think we all do. We all support it, and we'll all and I think there's a lot of money there looking for these sorts of opportunities, and they're coming from different places.
And just bringing in Bert, I'm presuming that you must have had pressure, I guess, from your end investors, pension funds, etc., in order to sort of make sure that all your investments are ESG compliant. So I'm just assuming now that are there certain commodities such as thermal coal or certain types of transactions that you will not touch?
Yes, I mean, first of all, I would like to really echo what Warren has been saying before. In the mining industry, and that obviously includes funds like ours as well, and what Gresham are doing, and et cetera, is that a mining company can only succeed if it has a positive social operating license, wherever it goes, right? So therefore, the mining industry for a long time, save for a few unfortunate examples, but by and large, the mining industry overwhelmingly long time has done the right thing for the environment, the right thing for the community, the right thing for all other stakeholders to get a positive operating license. So the ESG policies that are being introduced today, when it comes to the mining industry and mining funds, are by and large a formalization in a maybe comparable manner across companies and funds, a formalization of what has been successfully implemented anyway for a long time on project level and on company level, right? So now, and our investors obviously know that, yeah? Now, I would say, what is different now, let's say, than 3 or 4 years ago, in a mining private equity firm from an ESG point of view, is probably 2 things. One is there is the expectation, not necessarily the requirement, but the expectation that you have an ESG policy on fund level, yeah, and that there's some internal ESG compliance function to make sure that the underlying investee companies comply with that ESG policy, yeah. And as I said before, since on project level, all the companies were anyway doing the right thing, yeah, to actually institutionalize that is actually not such a big deal because of the need to have a social operating license. The mining industry and mining investments have always been very, very sensitized to that subject matter. So I think that, but into your specific question, what changed there has been, I think, the expectation to have an ESG policy on fund level and to actually kind of ensure its compliance. And secondly, as you say correctly, there's one commodity in particular, which is a no-go area, which is thermal coal, right? So there's hardly any mining private equity firm out there anymore that is able and willing to do primary thermal coal investments, right? And we are no exception here. Yeah. But I think other than that, the industry is already very compliant, has always been very compliant. It was just not called ESG, it was called health and safety and environment, right? To ensure it has a social operating license wherever it goes. So Yep, go on, Andrew.
Yeah, and I think that was just like a follow-up question, I guess, to George, is I guess from your client's perspective, how has decarbonisation and ESG shaped the advice that you're giving to your clients now?
So in our team, we have 2-3 people with technical background, and we lean on them to help our clients through the due diligence that we know financiers will conduct on the asset. And historically, the focus of that has probably been more technical and less on the environmental and social, just from the perspective of the balance of risks. And I think that has definitely changed in, not overnight, but gradually over 5 or 10 years, where actually more of their time is spent helping companies through the environmental and social due diligence that financiers will conduct in comparison to the technical. I mean, both are still important, but in terms of the weight of one over the other. That would be one comment I would make. In terms of decarbonisation, I think that the fact that lots of funds and most banks can no longer fund particular sectors, so thermal coal being one, uranium is often one that some banks have to avoid for policy reasons, has basically pushed a lot of the ownership of those assets into areas which have less scrutiny, which personally I don't think actually is a great thing. I understand why funds and investors face that pressure to not be investing in new primary thermal coal, but the development of those assets, because there is still thermal coal demand, massive thermal coal demand around the world, it actually means the ownership of those assets goes into areas that probably get less public scrutiny, and therefore arguably you could say there's a lower level of outside pressure, external pressure on those sorts of companies to manage their environmental and social impact as well as they can. Be that, setting that aside for one moment, in terms of new technologies, decarbonisation, I certainly would agree with one of the other panelists' comment around new pockets of funding being available for new technologies. So to take a specific example, there are some US bulge bracket banks which just don't really get involved in mine project financings unless it's for a particularly important client and it's a sort of key relationship that they have to follow, and then they'll sort of come into the deal at some point alongside other mining lenders. But if it's now a newer sector, or one that's associated with renewables or lithium, for example, or rare earths, then there's actually much higher level of appetite. And there are groups within banks now that are specifically set up to target green financings and sustainable financings. So there's been a hugely positive impact from a banking point of view in terms of access to additional pots of capital within the bank over and above what they would generally allocate to the mining space. So that's been particularly positive as well. It's definitely an area that's an increasing focus for us, and definitely a positive development, I think, for the mining space generally in terms of access to additional pools of capital in those institutions.
Thank you very much for that. A couple of questions sent in from the audience. I'm going to throw this one out to James first. What financing transaction or deal stands out over the last 18 months? And why?
A good question. I have to think. Look, I'll pick one. I think the largest transaction done last year in Australia, which I can think of, was a $550 million streaming transaction done by Triple Flag over the North Parks mine. I thought that was an outstanding transaction. It was large. It was executed in the middle of the year, which was a difficult time for travel everywhere. I suppose I could point to that one.
Okay, and what would you choose, Bert?
Well, I mean, when deals don't get done, I mean, there's usually reasons for it. The main reasons why some deals don't happen in the current market, because it's a commodity that the market, for example, doesn't understand, or because it's a company that's disappointed on the public market several times before because they haven't met the targets before, right? So these are typically the reasons when deals don't happen on the public market, right? Having said this, these are precisely the opportunities where sometimes then private equity comes in.
I'm going to ask Warren the harder question. What financing transaction or deal would you like to see happen?
You talk about M&A, Andrew, and the impact of different themes on M&A. And we've seen, the electrification and the decarbonization trends really being the theme that's been driving a lot of M&A in Canada and Australia in the last sort of 6 months or so. The one that hasn't happened and the one that I think needs to happen, should happen, is being overlooked because of this greater theme, shouldn't be overlooked and should happen, is consolidation in the gold sector. Gold has been strangely quiet in the last 6 months. We have record negative interest rates across the globe, and the price of gold is sitting there wondering what to do. We've got inflation, we've got real inflation, we've got negative interest rates. Is inflation good for gold? Is inflation not good for gold because it's going to lead to higher interest rates? Gold is sitting there looking at itself in the mirror thinking, what should I do? And it's fundamentally questioning the reasoning for its existence. And we have this great preponderance of gold companies, new, old, rejuvenated, as a result of the extraordinary yet somewhat brief bull market that we experienced last year. And we have just too many of them. And there's a huge opportunity for consolidation amongst all of those companies, and it's not happening. So if you ask me if there's something I would like to see happen, Andrew, I'd like to see that happen because the industry needs it.
So if, for argument's sake, I don't know, there's about 1,000 gold companies out there, how many would you like them to see it consolidated down to? 500, 250?
Yeah, exactly. It is a number that's an order of magnitude. It's it should be cut down by more than half, and put some efficiency behind this and some scale behind it. My friends and colleagues down in Oz will have seen the creation of gold companies at the most rapid pace in the history of Australia over the course of the last 6 to 9 months, where it seemed like a new gold company was being floated every single day of the week, and sometimes 3 gold companies. And at the end of the day, we all know there isn't that much good gold ground in Australia. There's a lot, but not that much. So someone's not getting the good ground amongst all those IPOs. So it perhaps has extended its stay a little bit too long in the capital markets, and there needs to be consolidation within the industry to reduce rather than explode the number of participants.
That's a lot of CEOs and a lot of board directors out of a job there, Warren.
And that's exactly the problem. That's exactly the problem why the consolidation doesn't happen, because no CEO, chairman of the board, or board member are voluntarily going to do themselves out of a job.
Yeah. Just kind of like building on a couple of comments that Warren made about mining M&A. George, what are the key mining M&A and consolidation trends that you're seeing?
Well, not the reduction of 1,000 companies into 500 or 250. I think, there have been some good transactions, I think, in the last 12 to 18 months, but we would agree probably not enough from the perspective of rationalization and actually the ability of strong teams to move assets forward. And regrettably, I think there are still far too many lifestyle companies out there, particularly in North America, where shareholder funds are simply used to tickle an asset along at a relatively slow pace, and the management and the board get to live off the benefits. And obviously, I'm not going to name any names. So that's the bad part of it. I think that there have been some groups that have successfully put business together, particularly in Brazil, we've seen, and in Mexico, we're involved in a couple of transactions there where outside funds have helped to sort of push teams together. But not always, but a lot of the time, it comes down to social issues between management teams and boards, and working out sort of who's going to be continuing. I think there's been some consolidation, and will continue to be some consolidation in the streaming space, or the royalty and streaming space, where the bigger groups, the established names, particularly in Canada, are finding a lower number of deals because of competing sources of funds. And so I think there'll be an increasing element of M&A activity in that space particularly, would be my view.
Okay. And I see that on the clock, my sort of like AV colleague is pointing out we have 5 minutes to go. So I'm just going to ask one sort of like round robin question to all sort of four of you. This panel is obviously part of our Mines and Money online global event. We've got a number of mining companies taking part, of which probably about 80% are at the exploration stage. If there was one piece of advice or one takeaway you want to give any miner at the exploration stage looking to secure financing over the course of the next 12 to 18 months, what would that one piece of advice be? I'll say with you, George, first.
Don't underestimate the time it will take.
Bert?
Don't bullshit investors. Everybody knows it's a high risk game. Don't use just sentences like "it's there, we know it's there." No, you don't. You only know if it's there once you've drilled. So don't give people just some sugar-coated bullshit. Just be very fact-based.
I can't imagine a miner even daring to even think about bullshitting you, Bert. I think they'd just be like too scared of you.
I've heard the sentence, we know it's there, we know it's there. So how do you know it's there? Well, because there's another mine nearby. Well, that's not a reason why it's there. So we've heard that sentence too often.
James, what would your one piece of takeaway advice be?
I think convey how much money is going in the ground. Convey where you're going to be doing your exploration and why clearly, and explain how much it costs to run the company. We all know it costs some money. We just want to see most of that money go in the ground.
And last, but by no means least, Warren.
Well, you know, everyone has the standard knee-jerk reaction about saying, you know, believe in yourself, stick to your guns, be persistent, just keep trying. Well, I don't think that applies to exploration. I mean, yeah, it does occasionally, but rarely. I think the idea is to be most successful in exploration is don't knock your head against the wall. If it's not working, find the right property and that'll work very nicely. Thank you very much. So don't flog a dead horse for 10 years, for 20 years, move on and learn your lesson.
Okay, thank you very much for that. So I think that just brings us to the end of this panel session. So all that remains for me to do is to thank Warren Gilman, Chairman and Chief Executive Officer of Queen's Road Capital, Bert Koth, Managing Director and Partner of Denham Mining Fund, James Morrison, Managing Director of Resources Royalties Fund at Gresham, and George Pyper, Managing Director Advisory at Endeavour Financial. My name is Andrew Thake from Mines and Money, and I hope that you enjoyed the panel. Thank you very much.